Depending on the size of a property, commercial real estate can often be priced at $10 to $50 million or more. So unlike dollar cost averaging into something like an index fund or even buying a single family home to rent out, it can be really difficult to make these investments completely by yourself. This is why most commercial real estate deals are funded with multiple different capital sources, and these funding sources are what are referred to in this industry as the capital stack. And since this topic can get a little bit complex, in this video, what I want to do is break down how commercial real estate deals are typically funded, how each layer of the capital stack ends up working together, and some things that you'll need to consider if you are weighing different options to fund a real estate investment. So I think the simplest way to explain this is by using a sample deal scenario. So let's say an investor identifies a property that's a great deal, but between the purchase price and all costs associated with the transaction, the total acquisition cost would be $10 million. Let's also say that this investor is an individual with experience in commercial real estate and they know they can add value to the property, but they personally only have $100,000 in savings that they could use to put towards an investment. So in this scenario, if this investor wants to pursue this acquisition opportunity, the first thing that they're likely going to do is look for what's often the cheapest form of capital from an interest rate perspective, and this is senior debt. Senior debt refers to loan proceeds that are typically funded by a bank, insurance company, or agency lender that will usually make up anywhere from about 50 to 65% of the cost to acquire a property, and the senior portion of the term senior debt refers to this lender having payment priority over other investors in the deal. This means that the cash flow the property generates is first going to be used to pay any sort of monthly debt service associated with this loan, and if the investor can't pay monthly debt service and defaults, this senior lender could take back the property. This also means that when the property is sold, the lender is going to be owed their entire outstanding loan balance at that time before the equity investor takes home anything. And if for any reason the value of the property has decreased to the point where this is worth less than the value of the loan itself, that investor's equity position would be wiped out completely. Now, in this case, let's say this investor is able to find a lender that's willing to fund 65% of the acquisition cost, or $6.5 million, which is a huge step in the right direction, but still leaves a gap of $3.5 million to finance the deal. And since this investor only has $100,000 to put up, the next thing that they might do to fund this transaction is raise capital from equity partners that would passively invest in the deal. And to do this, the investor that identified the property would typically create a partnership where they would act as the active general partner on the deal that would manage the property on behalf of other investors, and then they would go out and raise capital from passive limited partners that wouldn't be involved with the operations and would only contribute equity. And even though in most cases, LPs will typically pay the GP fees and potentially performance incentives in exchange for managing the deal on behalf of the partnership, these investors together would both be considered common equity investors, again with that senior lender having payment priority above both the general and limited partners. Now, in most cases, when a partnership is formed, a GP will fund about 5 to 10% of the total equity requirement to make sure that their limited partners know they have skin in the game, and then they'll look for the remaining 90 to 95% to come from their LPs who are investing in the deal. Now, for the purposes of this example, let's say that this investor has a huge network of both industry professionals and high net worth individuals, and they'd easily be able to raise 95% of the equity requirement, or $3.325 million, leaving just $175,000 remaining to fund this transaction. However, even though this is significantly less than that initial $3.5 million amount, with only $100,000, this investor is still going to come up short on funds. And in cases like these, investors will often look for another layer of financing to make up the difference. And from here, this is usually what's referred to as mezzanine debt. Now, mezzanine debt refers to an additional layer of debt financing, with this lender being in second position behind the senior lender on the deal. Senior lenders will also often have the right to approve or deny the use of mezzanine debt on a transaction because this incorporates additional monthly debt service obligations that ultimately increase the borrower's risk of default. Mezzanine debt also usually comes along with much higher interest rates than you would see on a senior loan because these lenders are taking on a higher level of risk, and they're also usually only going to be willing to fund a very small percentage of the overall capital requirements. In many cases, mezzanine loans can take a borrower's total loan-to-value ratio up to something like 75% or 80%, which can make it easier to raise a smaller amount of equity, but this also comes with the reality of much tighter cash flows and less room for error. So to apply this to our sample deal scenario, let's say that the senior lender signed off on a mezzanine lender funding 10% of the total capital requirements, or $1 million, bringing that equity requirement down to just $2.5 million and only $125,000 that now needs to come from the GP. But again, this is still more than what that GP has available to contribute. So to make up the difference here, investors will sometimes move on to an even more expensive capital source that often acts as a hybrid between debt and equity financing, and this is preferred equity. Preferred equity investors have payment priority above common equity investors, but they'll be behind both the senior lender and the mezzanine lender on the deal, and preferred equity payments are often structured as a mix of both current pay, which essentially acts as a monthly payment based on an interest rate, and accrued pay, which builds up over time and ends up being owed once the property is sold. This can often lead to all-in rates in the 15 to 20% range for preferred equity capital, which is why in most cases this is not used by investors unless absolutely necessary. But for the purposes of our example, in this case, this investor just doesn't have access to an additional $25,000 and a preferred equity provider that could contribute another 10% of the capital requirement would finally bring that GP's required equity contribution down below that $100,000 mark to just $75,000. Now, obviously, this investor is heavily leveraged at this point and taking on a lot of risk to fund this deal, but this is how individuals can end up controlling a $10 million asset with very little capital out of their own pocket, and this same concept scales up to $50 million deals, $100 million deals, or billion-dollar portfolios acquired by private equity firms. Now, we didn't have time in this video to go into the weeds on the details of each of these capital sources, so I'll link a few other videos in the description below that cover some of these concepts in more detail. And if you want to learn even more about each of these and how to actually model things like GP and LP cash flows, mezzanine debt structures, or preferred equity structures in Excel, if you haven't already, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking the CRE Analyst Certification Exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on different sources of funding in commercial real estate, make sure to hit the like button and let me know. And let me know in the comments if there are any specific capital sources that you'd like to see covered in more detail in a future video. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.